Good evening, everyone. I would like to welcome you on behalf of the President and the Executive Committee of the chapter to the webinar conducted by CA Sri Lanka chapter of Western Region KSA. For today's session, we have CA members joining us from Jeddah, Riyadh, and Dammam KSA. We also have members of other accounting bodies and colleagues from other professional bodies participating. I thank you all on behalf of the chapter for accepting our invitation and joining with us today. CA Sri Lanka members, please type in your name and membership number in the chat box. All participants, please feel free to post your questions relevant to today's topic in Q&A box. We have 4 panelists today. Our first panelist today is Mr. Sajjadullah Khan. Mr. Khan is a director of Deloitte Middle East. He is a fellow of Institute of Chartered Accountants of Pakistan. He specializes in cross-border transaction and application of tax treaties, inbound, outbound investment advisory, KSA corporate, Zakat, and income tax. Our second panelist today is Peter Dulowski. Peter is Financial Services Indirect Tax Leader for GCC region in Deloitte. He's a Chartered Tax Advisor and an Associate of Institute of Direct Taxation. Our third panelist is Kashif Jangir. Kashif is a Senior Director in Deloitte. He is a fellow member of Institute of Chartered Accountants of Pakistan. We also have Ahmed Makshood from Deloitte joining with us today. At the end of this session, we will take questions from the participants. Without further ado, I would like to hand this over to Mr. Khan. Mr. Khan, over to you.
Thank you very much, Mr. Osman, for the introduction, and thank you very much to the Executive Committee for giving us this opportunity of making a presentation on the Saudi Arabian KSA tax laws and whatever amendments and developments have happened over the past few years, I would say. And what we will be essentially covering is, as you would all sort of have experienced, that the tax department's approach has really sort of, changed, and in this change environment, how the tax department is really viewing things and what needs to be sort of, done to make sure that, yes, you are up ahead of the game. So while we would not be able to, within this limited time, perhaps take a very deep dive, but some critical issues which we have experienced, we would sort of try to cover those. And very quickly, the areas that, yes, we are going to cover is Zakat and tax. Then my fellow Kashif would be covering the withholding tax, and then overall, as Osman mentioned, the indirect tax would be covered by Peter and Ahmed. So it's very quickly moving on to Zakat and tax. As I mentioned, the approach of tax department has really sort of changed. And the change that, yes, we have experienced in the past couple of years especially, is that now the queries which are being issued by the tax department, they are very, very stringent in terms of timeline. They are very stringent in terms of the information that they require. They're very, very detailed. The number of queries that they are asking, and in many cases, we see that they are also sending reminders that your timeline is expiring, and they are getting more and more automated. The queries are coming through IRAD and no longer perhaps coming through a written sort of, document. So we are seeing that there is quite a lot of change there which is happening. And another very interesting change which is happening is the draft assessments are being sort of shared with the taxpayers to not only get their opinion, but also to get their consent. And again, the timeline that they are giving is very limited. With this change of approach of tax department, this new approach, what should really be sort of done and what is it really leading to? The final assessments which are coming up, they are going for conference call, discussing those assessments, and again, giving limited time. But the thing which is really positive is that the discussions now are sort of happening more and more. And we are seeing that, yes, tax department is encouraging the discussions, but again, they are taking very, very strict line. There is a legal department in which the objections can be discussed. And once an assessment has been issued, then you run into those deadlines of 30 days, 60 days, 90-day period in order to make sure that, yes, it reaches the right appellate forums. So this overall, these 5 crucial steps for the appeals, for the assessment cycle, this is what we're seeing as part of the new approach. So what is really sort of, in addition to this, what is really sort of changed? What is now tax department doing? Getting automated. What they are doing is they're going to other websites also. So they're going to Mukim and they're going to Upshare. And you might for a moment just think, what has the tax or zakat got to do with Mukim and Upshare? They go into Sama, that is a bit understandable. They go into customs website, which is now the Zakat and customs departments have already merged. But yes, they used to go to the customs website also. But then very interesting one, what is Mukim and Afshir got to do with Zakat and taxes? Any entity which individuals as shareholders, the tax department is now, especially particularly if the shareholders are Saudis, they want to see their presence in Saudi Arabia and for the payments which are being made. So just to give you an example of this, just a flavor of it. Let's say your entity, Saudi entity, has got three shareholders, shareholder A, Mr. B, and Mr. C. In the classical case, all these three are Saudis and they were based in Saudi Arabia. They used to meet the residency conditions of individuals. The Saudi entity, because it is owned by Saudi individuals, was subject to zakat. No problems there. Anyway, the dividends which was being paid to these three resident shareholders, there was no withholding tax on them. So it was clean area. But now moving on, what has happened is that if, for example, shareholder A becomes a non-resident, since shareholder A became a non-resident, whatever dividends are being paid to the shareholder A, those are now subject to 5% withholding tax. And we are seeing increasingly many entities falling on the wrong side of it. They're not deducting any withholding tax. Earlier, the entities were aware that if there's a shareholder which is an entity based outside Saudi Arabia, any withholding tax, dividend payments to them was subject to withholding tax, but that was not particularly sort of well known in case of individuals and in case of Saudi individuals becoming a non-resident. So that's where the Mukim and Upshare websites are helping Saudi tax department in order to ascertain the Saudi individuals' residential status and its impact on payments being made to those Saudi individuals. Tax department is getting automated. That's the first thing that yes, we are experiencing. And this is where the tax department is really particular and it's really going deeper into these things. Moving on, in the zakat-based calculation, there has not been any changes to the zakat-based calculation, which was already there in 2019 regulation, just a listing of those. So I'll pick up two items from here, which was also in a few questions that people were asking us. What we have seen is sources of financing. Tax departments stress on the cash flow statement and the reading of the cash flow statement is somewhat towards seeing that the zakat impact and how the investing activities are financed from the financing activities. For example, if you see this example, the investments of 500,000 and property and equipment of 200,000. So roughly around 700,000 of investing activities were performed during the year. But what had happened is if the facts are not known, the increase of share capital was towards the end of the year. So in that case, this increase of share capital would not have been used to finance the acquisition of investments or property and equipment. Likewise, let's say short-term borrowings and due to related parties, they may not have been used to finance the investing activities. But the challenge is what we are facing here is tax department in a plain simple reading, they say that yes, this 700,000 of investing activities against this 600,000 of financing activities. So a potential addition of all of this 600,000 to the zakat base because their contention is this was used to finance the investing activities and both of these investing activities amounts were part of the zakat negative base. So we can see the challenge is potential addition of a 600,000 to zakat base. Now this challenge of potential addition to zakat base, yes, there is a regulation, there is an article 43C, which is covering. So now what I'm mentioning here is that within that 43C limits, this is what Zakat department is currently doing. And there is also a calculation which is given for the calculation of the loans. So if it's an overlapping loan of 2 periods or more than 2 periods, how will that calculation be done? So all of those calculations done, this is where the Zakat department is taking it. And normally earlier, if it was less than a 354 days loan, that was not added to Zakat base. Now the tax department is seeing that this loan, was it a roll forward? Was it used to finance any deductibles? So all of those the points are now being sort of deeply evaluated by the tax department. Development properties. The conditions provided for the deduction of development properties are that these are classified as non-current assets. These are not available for sale. And the cumulative sales in advances received do not exceed 25% of their value, which is there in the financial statements. What we are witnessing here is the tax department is increasingly getting deeper into these in order to see that yes, the 25% threshold, has it really been met, and what are the conditions for meeting that 25% threshold before agreeing to the any sort of disallowances, any amounts that can be allowed. An interesting part of this is that the financial statements are finalized every year. So every year, because the construction industry is by its nature, things keep on changing. Every year it cannot really be the same basis which can be applied. So this is where the documentation has to be really strong, and it supports the position that on this basis these financial statements were finalized, and on that basis these amounts were claimed in the Zakat declaration. If that is not strong, let's say a year or two later on, when the situation, when the circumstances change, and if the documentation is not adequate, the tax department may not allow the deduction of it, and they may challenge that this 25% threshold is sort of met. Another scenario, another situation which is becoming very common is in case of investments, and the holding and subsidiary, how are they sort of interacted, and whether the deduction, the amount which is reported as deductible in, let's say, one entity, is it being subjected to Zakat in other entity in the case of a holding entity, in case of the group of companies. That is what this tax department is deeply sort of probing into. And an interesting one of this is the application of this in case of investments done outside Saudi Arabia, whereas a Zakat declaration now for the investment done outside Saudi Arabia that needs to be prepared. And not only that needs to be prepared, it has to be certified by a licensed accountant. All in all, the other thing very important, very significant from a Zakat perspective is the Zakat can be computed on an estimated basis. Now, this estimated basis is in what conditions? If, for example, you are unable to, or you do not file your Zakat declarations by the end of 120 days of your year end, let's say 30th April 2022, for the year ended 2021. Now, if you don't file or you do not provide the required documents, then what would happen is that the tax department, you're in giving tax department the power that they may estimate your zakat may go on an estimated zakat basis. For the first time, there is a statute of limitation, and now tax department has 5 years for correcting any errors. But these 5 years, they increase up to 10 years if, for example, you fail to submit your zakat declaration by the deadline. So let's say the deadline was 30th of April, but you happen to submit it on 1st of May. So you were late by 1 day, but you gave that 5 more years to tax department. If there was an incomplete form, or the form was the settlement of zakat due as per your calculation was not made, that also gives 5 more years to tax department. So overall, on an overall basis, just to summarize, the tax department's approach, supported by the change in regulations, is now much more aggressive, and this needs much more planning to ensure that you are not caught out on the wrong side of the things. Thank you very much. I'll pass over to my colleague Kashif, who will be sort of running through on the withholding tax part.
Thank you, Sajad. So moving on with withholding tax, if Judge can move to the next slide, please. Yeah, so basically, if you look at the, this is just a list of various payments that attract withholding taxes, and I wouldn't want you to go through all of these, but the important messages here are as follows. You can see that there's a broad range of withholding taxes from 5% down to 20%. And importantly, you can see that technical services and consulting services, when received from unrelated parties, the rate is 5%, and management fees, the rate is 20%. So it's a fourfold increase. So very important to determine whether the service is technical or management in nature. A few things that we've seen Zakat applying is that if they look at the word management appearing in the agreement, they would actually try and impose withholding tax at 20% on that contract. So importantly, try not to use that word unless it is absolutely necessary. Also, what is important is that you capture the nature of services very precisely in the agreement, so that, if technical services and management services are precisely there, and there's no way that you can say that there is no element of management service, then, if possible, put them in 2 different contracts. Because what we've also seen is that if there are 2 different types of services, that actually tend to apply the highest rate of withholding tax on the entire contract value. So that's also important. If you can park them in 2 different contracts, better. If not, at the very least, specific prices for different types of payments. The other important thing here is that within technical services, we have a different rate when technical services are received from related parties and when from unrelated parties, 5 and 15%. So what is important is that you look at what is the relationship between the payor and the recipient. So if you move to the next slide, the definition of related versus unrelated party, and the definition is different in the tax law and in the IFRS or transfer pricing regulations. Actually, IFRS definition is broader than the tax law definition, and the transfer pricing regulations definition is even broader than that in the IFRS. So under the tax law, 2 or more parties are considered related. For example, companies are considered related if there exists a common ownership-based control of more than 50%. And so it can be that A owns B 70%, B owns C 70%. So the effective ownership between A and C, although is 70%, which is 49%, is less than 50%. However, because A is related to B, so when you look at C's ownership, you have to look at A owning shares in C along with its related party ownership. That's how the definition works. So A and C in this example would be related. IFRS definition of related parties, as we all know, is slightly broader than that. And the transfer pricing regulation, it's even broader than that. So for withholding tax purposes, although technically speaking, Zakat should not apply withholding tax at 15% if the parties are not related under the tax law definition. However, in practice, we have seen, and we are actually dealing with cases where they have actually applied the IFRS definition of parties to be related and said, well, you're using the same brand name, so you must be related. So that has also, we've seen, so it's also an important thing to see. If we move to the next slide, then tax treaties. Again, it's a list of all the tax treaties we have, but importantly, you can see that we have a very rich treaty network, amongst countries from in Europe and in Asia. We have less so in Africa, very few in North and South America, and then Australasia, we do not have any treaty with Australia or New Zealand. On the European side, the important thing to note is that we've covered all the major economies. However, one of the important trading partners is not there, that is Germany. So we do not have signed any tax treaty with Germany. For some reason, I don't know, but I understand that that is under negotiation. The other important thing is that the US is our largest trading partner probably, but we do not have a tax treaty with the US. In the Asian column, you can see that we've got United Arab Emirates. Amongst the GCC member states, the UAE is actually the first and the only GCC country. Actually, the treaty between Saudi and the UAE is the only tax treaty between any two GCC member states. That is an important one. And we'll dive down in a little more detail in the tax treaty between Saudi Arabia and the UAE, because it's very common for multinational companies to operate in Saudi Arabia and also operate in the UAE, or sometimes, you know, your central leadership is based out of the UAE. That is changing recently though, but you know, the tax directors are there, or the CEOs are there, or the management company is there, and then they've got the hub there, and then spokes across the GCC, including Saudi Arabia. So if you move to the next slide, we look at the tax treaty between Saudi Arabia and the UAE. The treaty is effective from 1 January 2020. And it's a unique treaty that Saudi Arabia have signed, in the sense that it embodies most of the provisions of the MLI, you know, the BEPS MLI in the tax treaty. So we've got this principal purpose test in the tax treaty. The treaty clearly says that this treaty benefit will not be available to any party if it is found that one of the main objectives of them entering into these arrangement and using the treaty is to avail of the treaty benefits. So that is also an important thing. Next one is the anti-fragmentation principles. So if you are trying to avoid a permanent establishment by parking different bits of a contract into under different agreements, that wouldn't work. The treaty, there are very few Saudi tax treaties that have the force of attraction principle embodied in the tax treaty, and the UAE one is one of those. So if you have a branch or a permanent establishment of a UAE entity in Saudi Arabia, the force of attraction principle is still applicable. Service PE is something which is, again, we know, an agency PE, we know that in the Saudi Arabian legislation, Zatka have this position that you create a service PE without having any physical presence in Saudi Arabia, and they have taken this view even on major economies and mature tax jurisdictions, including the UK, etc. And with the UAE, of course, they would be far more aggressive. So that is again there. Insurance business, again, in common with Zatka's approach on insurance business in general. In most, if not all, actually, tax treaties that Saudi Arabia is a party to, the taxation of insurance business is set out that in the treaty that is to be under the domestic law, because we've got very broad-ranging taxation regime for insurance companies. I'm sorry. So even if a non-resident reinsurance company is selling insurance policies or arrangements with the insurance companies in Saudi Arabia, the non-resident entity is treated to have created a permanent establishment, even if they are dealing with Saudi clients through independent distributors. Capital gains, again, Saudi tax regime has quite, I would say, broad-ranging provisions. Mainly, capital gains under the treaty are taxable under the domestic regime. There would be no difference, if you are applying the tax treaty also. Government-owned entities is again a very interesting provision. So it would look like that because there is an exemption for government-owned entities, but the language is not very clear. So the language actually says that entities owned by the government of a country. Now, it does not say directly or indirectly. Some people that I've spoken to in that are of the view that the Saudi tax law clearly talks about direct or indirect ownership. Like Article 2 of the Saudi tax law clearly says, Article 1 of the bylaws clearly says that any entity owned or capital company owned directly or indirectly. And they're of the view that where in the treaty it is not mentioned indirectly owned, it means that only directly owned entities would be able to benefit from this exemption. So if a UAE government has an entity in the UAE, which then has an entity in Saudi Arabia, so that benefit would not apply. If you move to the next slide, please. Yeah, so this is just a comparison of the tax rate, withholding tax rates under the treaty and under the domestic law. Domestic law, as you can see, we know the rates ranging between 5 and 20%. In the treaty, interestingly, we see that there is an exemption. However, very importantly, the management fees and technical service fees can potentially trigger permanent establishment in Saudi Arabia, and that is a very important thing to consider, especially Zatka's approach on virtual PEs. That needs to be considered. If we move to the next slide, please. Yeah, so Zatka have, as I was mentioning, that Zatka have actually taken this view about virtual PE, and they have denied treaty benefits in a number of cases where the total duration exceeds the threshold set out in the tax treaty, 6 months in case of the UAE. So very important to ensure that you do not have, and now especially important because the UAE also are going to come up with their own corporate tax regime. So what you would not want is that Zatka impose a permanent establishment on a virtual basis, and the UAE tax authority, although they have mentioned so far that they would give a credit for foreign taxes. However, they may say that, well, under the treaty, you don't have a PE actually, so we would give you a credit, but a tax due, this tax is not due. They may take a view that you do not have a tax due. So sometimes you may consider even registering a PE voluntarily rather than Zatka determining a PE on companies, because at least you would get a tax credit in the other country. That is another important point. And if we move on to the next slide, please. So I want to leave more time for Q&As. So increased focus on withholding tax compliance. What we've seen is that Zatka are now getting more aggressive. In the last year, they issued a number of notices to quite a few companies, actually. A lot of them are clients, of course, as well, and asking for withholding tax evidence in relation to payments made to non-resident parties in the last 10 years. So Zatka informally, well, formally actually, have taken a view that withholding tax demands can be raised for a period of up to 10 years. Informal discussions that we have had with some officers, there is a group within Zatka which is not seeing this as a good approach, and they do consider that it should be 5 years, but that is an important thing to consider, that you are exposed to withholding tax liabilities for up to 10 years. And now that Zatka are integrated with SAMA as well, they do get notified for payments made to foreign companies. The other important thing is the point of withholding tax. What we have seen is that Zatka, in a number of cases, have actually tried and sought to impose withholding tax on an accrual basis, especially between related parties. And we've successfully argued against this position. We have said that no, withholding taxes, the triggering point is payment. So therefore, there should be no withholding tax if there is no payment. However, if you have been artificially, if a company has been artificially managing payments, like having a receivable account and having a payable account, both running separately, simultaneously, and saying that there are loans granted by the Saudi entity, or payments are being made on some other account, etc. Zatka can actually challenge that, and I think they would invoke what I've seen also, anti-avoidance provisions in those cases. The next important, if you can go back to the previous slide, please, because there's one more thing, which is visit visa employees. So what we have seen is that Zatka are applying a 15% withholding tax on employees that you hire, but if they are not on your Iqama and they are not registered with COSI, so when you pay them, Zatka are actually applying a 15% withholding tax. Now, there are two internal circulars issued by Zatka, which essentially say that an employment is a mixed question of law and fact. So you have to determine whether the relationship between the payer and the recipient is that of employer-employee, or is that of a service provider. And there are some tests set out. Happy to discuss those if anyone is interested afterwards. That if it is established that it is an employer-employee relationship, then there should be no withholding tax. But in a number of cases, Zatka have actually imposed withholding tax. The other important thing is what we've seen is Zatka's, ask about reconciling withholding taxes and reverse charge VAT. So looking at a payment made in the withholding tax return and asking for, show us in the VAT, did you reverse charge? Did you account for VAT on a reverse charge? Likewise, going the other way around as well. So that's also an important thing. Statute of limitation we have already discussed. I'll move on to the next slide. Zatka's guidelines on withholding taxes. Again, these are Zatka's views. So withholding tax applies on payments by PEs to non-residents. Again, Zatka are of the view that if a PE is making any payments to non-residents on a construed basis, a construed payment, i.e. a cross charge from a related party, there should be withholding tax. Whereas the other thing that Zatka said, that if a KSA resident party is making a payment to a PE in Saudi Arabia, then there is no withholding tax that applies. Now, on the second one in particular, under the tax law, all payments to non-residents are subject to withholding tax, including payments made to a PE. However, we know that in a long-standing practice, Zatka have never imposed this requirement. Insofar as any PE that is registered with Zatka and has been filing their returns, they have never established any withholding tax defaults. Another important thing is that Zatka have taken a view that any subscription payments, to access any information or database should be considered as royalty and subject to 15% withholding tax. I think we can take a different view, but it might not be very beneficial. Actually, royalty might actually help in some cases. So for example, in certain instances, if it is not subscription fee, it might be seen as an other service, for example. And again, there can be arguments for and against. But for royalty, at least there is a possibility of availing of a reduced tax rate in certain tax treaties, like the UAE, for example, has 10%. The Dutch one has 7%, the UK one has 8%, etc. And management fees, they say that should be paid for specific services performed and should add a commercial value. And that is really, I think, the end of my slides. If we go back to the next slide, please.
Yes.
So Sajjad, over to you now again.
Thank you, Kashif. It's now Peter's turn actually for the VAT slides.
Hi everyone. Let me see if I can share my screen. Can you see the presentation?
Yeah, Peter, we can.
Okay. So let me just see if I can make sure I can see this all at the same time. There we go. Right. Thank you very much, everyone, for your attention. Today, I'm just going to cover the latest sort of developments on VAT, in particular around e-invoicing, and also a recap of the real estate transaction tax. I'm conscious that I also have my colleague Ahmed following on customs, so I will rush through, but please do put your questions into the Q&A and we will look to answer them either at the end or subsequently. So what has been happening around VAT in the Kingdom of late? Well, we've had some amendments in the last year to the implementing regulations around Article 53, as you can see there, self-billing and third-party billing made subject to specific approvals. The simplified tax invoice regime being made compulsory for B2C supplies, and of course the requirements in terms of content and format coming in for the purposes of e-invoicing. The changes to Article 53 also introduced some additional time for financial services to produce summary tax invoices by the 15th of the following month, whereas for many simplified invoices, the requirement is that they be provided effectively instantly. But also as a condition of that, for the financial services invoices, more customer data has to be included, and options were introduced in relation to the Zakat governor's powers to provide for exemptions or reliefs from some of the invoicing requirements for certain sectors or certain businesses where they could demonstrate, for example, a level of hardship from the provisions. In practice, we've not seen Zakat be minded to give any substantive reliefs. Then on Article 54, also changed around the same time. We saw requirements around credit and debit notes being aligned with e-invoicing, the need to provide an explicit reference back to the original invoice being amended. And in terms of Article 66, there were again changes around the requirements on local storage and access for Zakat to the records. And then more, and so all of those first three are really around sort of preparing the legislation for the requirements of e-invoicing. Then Article 20, which is different, it was effectively introduced as a relief in respect of the supplies to the government sector, recognizing that many suppliers to that sector struggle in waiting long periods of time for the government entity to pay its invoices. And so this Article 20 change meant that where the supply is directly to a government body and is covered by the new procurement law, the law on sort of procurement tendering, then the issue of an invoice does not create a tax point. The tax point instead will be the earlier of the receipt of the cash or the issuance of a formal purchase order. And in practice, there would nearly never be a circumstance where, if the process is followed properly, cash would appear in your account before you had the purchase order issued. So that has led to a number of our clients having to look at their systems and their processes for determining when amounts of VAT are to be reported in the return. And it also, of course, it leads to issues and questions over which supplies are actually covered under the new procurement and tenders law. And the rules are quite strict in terms of subcontractors involved in the chain of supply. These time of supply changes are only applicable to the final supply to the government entity. So those are the key amendments that we've seen in the regulations. And we'll come back to e-invoicing in a second, but I just wanted to give an overview of real estate transaction tax. It has been around for a while now, but we still find in practice that people maybe don't appreciate quite how broad an extent, how broad a scope it has. So this slide just explains the different types of real estate transaction, everything from straight sales of real estate assets through to finance leases, boot contracts, build, operate, own and transfer contracts, barter arrangements, legacies in wills, gifts, the granting of usufruct of a land of more than 50 years, and arguably also the transfer of existing usufruct would all be covered. But there's also this concept of a real estate company where more than 50% of the assets are in chargeable real estate, and the that would itself also be subject to 5% RETT, and these supplies will all be VAT exempt where the RET applies, with the exception of usufruct granted over 50 years, where both VAT and RET would apply. One of the very common aspects that, again, we find clients becoming confused on is that the definition of a real estate asset isn't just linked to situations where the transferor owns the land. The asset definition also includes fixed plant. And so in the boot contract scenario, for instance, we very often see a grant of land from the future recipient. who owns the land and who says to the project company, please build a hospital or please build a desalination plant on the land, operate it for 20 years, and then transfer it at the end of the useful life. And that, even though the operator never has a ownership of the land, the transfer of the plant, the title to the hospital or the desalination plant, would trigger 5% RETT, and there would be implications as well for VAT recovery. So if I move along to the timeline so far, RET comes in October 2020, just under 2 years ago. Then some simplified and detailed guidelines were issued along with the implementing regulations. However, the primary law is still in draft and it still hasn't been published as of today. It's with the body of experts and the committee at the policy level determining what the final changes will be. And we had amendments in January 2021 and in June 2021, the update to some of the administrative procedures around claiming VAT. So this regime, the licensed real estate developer regime, was introduced so that if you were a property developer and you were now, after the introduction of the tax, making 5% rentable supplies and had VAT exemption, that you weren't penalised, that you weren't impacted too much because you're able, outside of the normal VAT return process, to file claims under this regime and to receive back repayments from Zakat directly. Most recently, under point 6 there, you can see that there's been a further consultation on changes to the implementing regs. All the time, we still haven't got the primary law, but the implementing regs are the only legislation that's officially active, and yet people are paying the tax. Those changes were confirmed on the 18th of February, and they included clarification of certain points around the timing of RET payment in relation to off-plan sales, which was a big issue in the retail finance or mortgage finance market. They extended the concept of or the level of the exemption for transfers between relatives, and they removed a ministerial power to provide a sort of residual exemption. So that's the background on RETT. I mentioned this scheme for licensed developers, and the due date for that, where you can only have one claim per period, but the due date, the last date you can place claims is 6 months after the end of the calendar year. And we see there's possibilities there to file quarterly or to do a sort of an annual approach, but you can only do one claim per period. And once you've made that claim, you can't then adjust or resubmit. And then in terms of the issue of the capital asset scheme, so a number of you will be aware the VAT recovery that you initially apply to your assets that are capital assets used in the business is adjustable over a period of years, up to 10, depending on the economic life of the asset. And then here we would be saying, well, if you know at the outset that you're going to make now a VAT exempt supply, say in the example of the boot contract in 20 years time, what does that mean in terms of your VAT recovery for the construction costs? What does it mean in terms of your costs, VAT on costs of operating the asset in a boot scenario? And there are arguments for and against making an adjustment and either recognizing the future exempt supply or looking at the supplies year on year that you're making that will be taxable in that example. So again, just an issue to be aware of, that there could be implications for VAT incurred by clients even in back to 2018 if they're being adjusted, the VAT amounts are being adjusted under the capital item scheme. And then I'm going to skip over the wish list on the real estate transaction tax just for the interest of time. E-invoicing is probably the biggest individual topic that is taking up my and my colleagues' time in indirect tax of late. For anybody not still aware, we are in the generation phase, or phase 1, which went live on the 4th of December 2021, and that involved resident suppliers, resident VAT registered suppliers needing to be able to produce machine readable e-invoices and to store those in the kingdom. The second phase, which will be piloted with a number of large businesses from the 1st of January and will eventually be applicable to all VAT registered businesses in the kingdom, involves not just creating and storing and issuing e-invoices, but also an integration with Zakka systems. And in outline for business-to-business invoices, those would be validated with Zakka, and a code would be provided proving that those invoices have been validated with Zakka prior to the invoice being issued to the recipient. And in the case of simplified tax invoices, so B2C primarily, those would be reported to Zakka periodically. So we're still waiting in some cases for final confirmation of exactly the level of integration that Zakka are going to be looking for in phase 2, but pilot sort of projects to go into phase 2 are well underway. And one of the common issues that we face, we hear from clients, is what does constitute an e-invoice, and if I receive a machine readable, a human readable format invoice in PDF, is that sufficient evidence for my VAT recovery? Now, strictly under the rules, a machine readable invoice just needs to be generated. It doesn't need to be provided to the recipient to meet the supplier's requirements under the rules as they currently stand. But we would obviously advise that in order to secure input tax recovery, the party claiming needs to have strong evidence that an appropriate machine readable invoice has been generated, and that the human readable form, that if they retain that, does have a machine readable invoice backing it up, or itself meets Zakka's views of what an appropriate formatted invoice is. After the pilot goes live, after phase 2, then for B2B this shouldn't be a problem, because there should be a proof that the relevant e-invoice exists in the code that comes back proving that the invoice has been submitted to Zakka. But yeah, a very key practical problem, and the other problem being making sure that the recipient of the invoice has provided the accurate CR and other information that's now required to be shown on the invoice. And I think here we're just explaining the different elements that are needed, and the shift from phase 1 in that first column to phase 2. This slide is for the standard tax invoices and e-debit and credit notes. And then for simplified, the real difference there is just the QR code being required. And that is all that I wanted to share with you today. So let me just stop that, and I'll pass over to my colleague Ahmed, who will be talking to us about customs. Thank you very much for your attention.
Thank you very much, Peter. Hi everyone, good evening. Assalamu alaikum, this is Ahmed Al-Maqsood. You can hear me? Hello, can you hear me?
Yes,
we can hear you.
Okay, thank you very much. Thank you. Okay, let me. Yes, here I am. So I will just very quickly share my slides as well. So yes, maybe very quickly in the next couple of minutes, I will provide you with some highlights on the key changes in the customs landscape in KSA. And we are going to start with what is the key drivers for Saudi customs today. As you may be aware, the key update in last year was actually the merge between Saudi Customs and the General Authority of Zakat and Tax, forming the Zakat, Tax and Customs Authority, where actually the KSA government added, customs under the umbrella of, the indirect taxes, VAT, excise, and customs, to ensure a seamless application of the applicable policies and procedures between direct and indirect taxes. So this was actually a very important move by the KSA government to manage or better manage and control this vital revenue generation authority. If we talk about what are the key drivers for ZATCA following the merge or post the merge, so of course the first driver would be revenue generation, which is not a surprise. Tax and customs authorities in most of the countries all over the world are one of the most revenue generating authorities. So the key driver now is revenue generation, and all the other drivers that we are going to discuss is linked more or less directly or indirectly to this key driver. So the KSA government or ZATCA or customs has realized actually that there has been a lot of revenue leakage from a customs perspective, and that was for two main reasons. Number one, some importers were intentionally, trying to manipulate, customs and, for example, reducing the value of the imported goods or declaring incorrect HS codes to pay lower duty rates. And some other entities, they were not compliant, not intentionally, but actually due to the lack of technical customs knowledge and expertise and the awareness about applicable rules, customs rules and regulations in KSA, that led to non-compliant and being subject to a lot of fines and penalties, as we are going to discuss in a few minutes. So in order to raise actually the level of compliance between importers in KSA, so Saudi Customs on the other side wants actually importers to be more compliant on the long run, and for that they have introduced or announced a number of initiatives that can encourage importers to be more compliant. As an example, the Authorized Economic Operator is one of the programs that was introduced by Saudi Customs and now ZATCA after the merge, to encourage importers to participate in that program and get financial and non-financial facilities and benefits. One of the key drivers as well, and the key developments that we have seen last year, on definitely on the 2nd of July in 2021, was the introduction of the new rules of origin, the new KSA rules of origin, where Saudi government has put some specific regulations for goods originated in other GCC countries to benefit from the preferential treatment and duty exemption in KSA. So previously those goods were coming and imported to KSA and enjoying custom duty exemption, but now they need to meet specific criteria. For example, 40% value added and 25% localization rates in the GCC country in order to get benefit of the preferential treatment in case A. One of the key drivers is the post-clearance audit, which was an initiative introduced by Saudi Customs back in 2018, and we will, spotlight on PCA in a few moments. So the other key drivers is the undervaluation, and as you can see, it is linked to the revenue generation. So undervaluation of imported goods is one of the key points that customs will, or the customs auditors will check when they do the post-clearance audits. So they need actually to ensure that the value declared to customs is the correct value, and this value is matching with what has been recorded or booked in the commercial and financial records of an importer. From a valuation perspective as well, one of the key points or the key drivers that has come to the top of the discussions in the few, let's say, the past few years, is the interplay between transfer pricing and custom valuation. And since the introduction of transfer pricing regulations in 2019 in Case A, this topic has been one of the key areas multinational entities are exploring in Case A, because of course, as you may be aware, the contradictory approaches between customs and tax. So customs need to raise the value in order to collect more duties. On the other hand, from a tax perspective, the tax department need to reduce actually the value of the imported goods to increase or to raise the tax base, which will lead to payment of additional taxes. Also, the wrong classification, and I mentioned it already, the wrong classification to avoid payment of duties based on higher duty rates. The reconciliation is one of the key drivers and key issues that customs has been focusing on in the last couple of years. The reconciliation between foreign purchases declared in the tax return versus the imports as per the customs records. And there has been now a trend that previously this was looked into from a tax perspective only, but now it is also looked into from both tax and customs perspective too, and importers actually are asked and requested to justify these discrepancies, not only from a tax perspective, but from a customs perspective as well. So I will zoom into the post-clearance audit initiative very quickly, which, as I mentioned, was an initiative introduced by customs back in 2018. Before that, there was no post-clearance audit, no field audits was undertaken by customs. It was only desktop audits. But since the implementation of this initiative, customs, they went to the taxpayer, they went to the importer premises, they check their financial records, commercial records. They ask for a lot of information to ensure this importer is compliant with applicable rules and regulations, mainly from a valuation perspective, from an origin perspective, from a classification perspective, and also to ensure that all the customs information matches with other taxes and reconcile with other taxes. So post-clearance audit actually is a global initiative applied by WCO, World Customs Organization, World Trade Organization, and it is also embedded in the local GCC Common Customs Law as per Article 127. This is how actually the post-clearance audit look like. It starts with the verification and desktop audits, and if that is fine to provide a report to the importer, this will be done. Otherwise, customs will notify the importer that they are going to do a field audit and a field visit to their premises, and they can visit one time or twice or 3 times as they see fit to ensure, they collect all the information they need to trigger the analysis and to complete their review. And actually, the process, like other tax audits, will end up with either raising an assessment to the client or telling the importer that there was no findings as a result of the audit, but based on what we have seen in the market and with our clients, the customs department has been very aggressive when they do the audits, and they found a lot of non-compliance and inconsistency, and they are raising a lot of assessments and massive assessments so far. From a prescription period, just for information, from a custom perspective, the prescription period is 5 years, but it can be extended to 15 years in case of a smuggling offense. So we listed out some key risks that we have seen. I will pick up only a few of them, just to let you know what customs are looking when they do the post-clearance audit. So the valuation, the undervaluation of the import values, and for example, under the category of undervaluation, we can include, not including all the dutiable elements that should be included or should constitute part of the customs value. For example, royalties, because actually Case A is a WTO member. It is a member of the World Trade Organization, and they apply the WTO valuation agreement. And as per the valuation agreement, specific or certain adjustments need to be done on the transaction value in order to come up with the correct customs value based on which the duties are calculated and paid to customs. So, for example, if the importer is paying royalties to the brand owner, to the principal, and these royalties are related to the goods and they are a condition of sale, if they are not included in the value declared to customs, when customs will do the audit, they will check the contracts, they will detect these royalties, and they will raise an assessment to pay the duties due on these royalties. And also, at the other point, the customs will check the consistency with other taxes. So, for example, since we are talking about royalties, if during a tax audit, the tax auditors identify that this importer is paying withholding tax for royalties, as mentioned by Kashif a while ago. So an importer is paying withholding taxes for royalties, 15%, for example. So they will immediately exchange this information with the customs auditors. They will tell them this importer is paying royalties. Go and check whether those royalties were declared in the customs value or not. And we have seen practical cases and assessments of millions of Saudi riyals due to this misdeclaration of the customs value. So one of the other issues that has been under the focus or the radar of customs during audits, the application of free trade agreements. So if you are importing goods under, let's say, the GAFTA free trade agreements from Arab countries to KSA, customs will focus a lot on whether those free trade agreements was applied correctly or not. As an example, goods imported from free zones are not qualified for the preferential treatment. And a lot of imports coming from free zones in Arab countries, were actually exempted based on those free trade agreements due to lack of check on the borders. But when customs now come and check, the records and and the books and the systems can easily identify which entity you are importing the goods from and whether it is placed in a free zone or not. And they can easily ignore the preferential treatment and ask the importer to pay the duties for the past 5 years. So these are some examples what you need to do. So importers need to prepare themselves for a pre-audit prevention phase. They need to do health checks, build a strategy, defense strategy. In case of any audit, they can defend their position. So during an audit, we always recommend our clients to have or to seek assistance from customs experts to assess them during the audit, because any information that can be exchanged to customs without carefully checking this information may be used against you as an importer. And we also, encourage, our clients and taxpayers to explore the litigation and dispute resolution process. Once, in case you receive a collection order from customs, you have 30 days. And just to be aware, the timelines for the customs appeal and objections is quite different than those for tax litigation and dispute resolution process. And of course, as an outcome of the audits, importers need to take the required remedial actions to avoid, having this inconsistency in the future. The impact of non-compliance can have a very significant implications on your business, either it is financially or non-financially. So from a financial perspective, fines and penalties from a custom perspective can go up to twice or third the value of the goods or the due duties, and it can also lead to some administrative consequences like cancellation of trading license or a lot of supply chain disruptions and delays in the release of your goods. And finally, these are some questions we have prepared that importers need, especially nowadays and following the merge with ZATCA, and given how aggressive the tax authority or ZATCA becomes and the joint audits they are doing from a direct tax and indirect tax perspective. So importers need to be fully aware on the applicable rules and regulations in KSA from a customs perspective, and they need to comply with them to the extent possible. This is actually all what I wanted to share with you this evening, and I'm sorry maybe for taking more time than expected, and I'm happy to take any questions you may have, and thank you very much for your listening.
Thanks, Ahmad. I think now we can take questions from our participants. So I can see some questions being posted on Q&A box. The first question is on WHT. I think anybody from the panel can take this question. If it is a branch, does it need to pay withholding tax if double tax treaty exists between two countries? For example, franchise fee payment. If paid withholding tax irrespective of treaty, can it be deductible expense when it comes to calculate income tax for foreign branch? Mr. Kashif, I think your mic is on mute.
Yeah, apologies. Yeah, so I'll take this one. It's not clear whether the question is in the context of a branch making a payment to the head office, or branch making a payment to a related party, or to a third party. So I'll just briefly discuss all three once. So branch making payment to a third party is required to withhold tax, and that comes from the fact that in Article 5, it is very clearly mentioned, dealing with the income sourcing rules, that a branch making a payment or a permanent establishment making a payment should be treated as if the payment was made by a resident company. So that's one. A branch making payment to a related party, again, the same principle as the first one I explained should apply, that it should also be subject to withholding. And both of these should be deductible expenses also, whether to a third party or to a related party. Now, the third one is a branch making a payment to a head office. And now it's a very interesting one, because typically, you wouldn't, first of all, as a principle, if there is a double tax treaty, and that is mentioned here, that if there is a double tax treaty, if a double tax treaty exists, then the branch and the head office should be treated as two distinct entities dealing with each other on an arm's length basis. This is based on Article 7 of the OECD Model Tax Treaty, and the Saudi tax treaties are all based on the OECD Model Tax Treaty. So that provision is there in most, if not all, of the tax treaties that we have. So to the extent tax should not be deducted, for example, that position can be taken. The problem arises that Saudi Arabian tax law and Zatka's approach in interpreting the treaty is very different. So they say that if any work in relation to a service is even partly undertaken in Saudi Arabia, then the entire service is considered as having been physically performed in Saudi Arabia, regardless of the physical presence of the service provider. This is based on Article 6 of the tax bylaws, and they say that this provision is not in violation of the tax treaties. It actually expands the concept in the tax treaty, which says that in a service PE context, you have to consider the activities. If the activities are continuing in the other state for a period more than that the threshold set out in the tax treaty, then you have a permanent establishment. So they look at that and say that, well, you have created a permanent establishment as long as you are providing service where any work in relation to the service has been provided in Saudi Arabia. And the same thing they would look at in a branch versus head office scenario. They would say, well, this income actually, if the part of the work or any part of the work has been performed in Saudi Arabia, then it should attract, if you're not withholding tax, then the related income should be considered as Saudi source, because, or the activity should be considered as performed in Saudi Arabia. So this income should be attached or added to the income of the PE accordingly, because the PE is kind of, the head office is doing the service in Saudi Arabia, and because there is a PE, so you have either created a second PE or the same PE that you add the income to that. So the second part of this question is very interesting, which is that if it is not subject to withholding tax, then is the expense, if it is subject to withholding tax, is the expense deductible or not? So if the expense is not deductible, and there are certain instances where expenses are not deductible in relation to payments made by a branch to a head office. So for example, any royalty payment or any interest payment. And then Article 68 of the tax law, and also Zatka's interpretation, I think there is an FAQ on this as well. It's very clear that if the expense is not deductible, then the withholding tax that you have applied, it becomes creditable against the corporate tax liability of the branch in Saudi Arabia. So either way, if you apply withholding tax, you can claim a deduction, which might actually suit you in some instances, because you may be applying withholding tax at 15%, but the corporate tax deduction would be at 20%, and also you wouldn't have to pay branch profit remittance tax. So there is effective rate of 24%, whereas you are paying withholding tax at 15%. If you do not get or cannot get a deduction, then any withholding tax that you pay should be creditable against the branch's tax liability in Saudi Arabia. I hope I've answered it.
Thanks, Mr. Kasur. I think that is very well elaborated. I think we can move on to another question, a fairly straightforward one. Remote working is a common thing in the current business environment. So what will be the WST impact on salaries paid to remote working employees, assuming that these people are working outside Saudi Arabia?
I think, yeah. I mean, don't worry about the straightforward or not so straightforward one. So, that shouldn't be the criterion. But anyway, again, an employer, an employee, and an employment is a mixed question of law and fact. So whether someone is an employer or an employee is determined not just having an employment agreement. Yes, that is an evidence, but also based on what is the relationship between the two. who controls their timings, who is responsible for their work, etc. For example, I cannot penalize an employee. My employee, for example, if he goofs up on something and we suffer a loss because of his inaction or wrong action, but I can penalize the service provider. So it's a question of fact. If it is an employer-employee relationship, regardless of where the employee is working, if he's an employee, you may have a separate question on whether the employee working abroad can create a taxable presence outside KSA. That is a completely different question. But insofar as payment to an employee is concerned, there is no withholding tax on salary payments. Thank you.
Also, there are a few questions which are personally answered. I think for the interest of all the people who are attending the session, I think I can put it in the forum. What is the treatment of development property in calculating the zakat base? That is, can it be deducted like any other asset? So,
Yes, it can. I answered it. Yes, it can.
Yeah.
It can be deducted like any others, provided the conditions are met.
Yeah. Also, another question I think privately answered. I'll just post it for the interest of all the people. If your statement of financial position, that is balance sheet, is prepared based on in the order of liquidity and not classified to current versus non-current, is this acceptable by the authorities? And how will be zakat calculated?
Yes, the zakat will be calculated normally with the order of the balance sheet in which it is prepared. That is not what is the basis for calculation of zakat.
And there is another question. We are making some payments relating to technical services through service providers payment gateway, and they've named few payment gateways. At the time of the payment, we are not able to deduct withholding tax as we cannot proceed with the transaction without paying the full amount. So what is the remedy for this kind of transaction?
I think this is an IT question. This is not really a tax question. I can only tell you what the tax law says, but I cannot really solve this problem, honestly.
I think it's more of an operational question. Fee paid to an influencer as marketing expenses who is based outside Saudi Arabia, where his or her follower could be in KSA or in abroad. Is this payment subject to withholding tax? And if yes, at what rate?
It really depends on, again, as I mentioned, that any service is considered as performed in Saudi Arabia if any activity in relation which is required for the service to be performed is undertaken even partly in Saudi Arabia. The way Zakat look at this is they take a very expansive view. So for example, this training, let's say that I am providing this training from outside of Saudi Arabia. Zakat would look at this and say, well, to receive this training, Usman, you had to open your laptop, you had to click on this Zoom link. This is a work which is necessary for Kashif to actually deliver this training. So therefore, Kashif has delivered this training in person in Saudi Arabia. So we have to look at, in this context, what is the arrangement between the influencer and the person making the payment and the service that the influencer is providing. And there can be a few areas here. So one is, if the influencer is just, you are paying them to put some, to advertise your products, and they are just doing it, all of their job they are doing is outside Saudi Arabia, potentially you can say, and then again, we have to look at whether there is a tax treaty or not, because if there's a technical service, because partly and how the arrangement is structured, if we say that no, there's a technical angle, not everyone can actually do this. You have to be artistic, etc. To do this. Then technical services, if they are provided to a resident company, Saudi sourced income. If there is a tax treaty, then we have to look at the tax treaty provisions, should not be Saudi sourced income. However, we have to again look at if there's any work that is being performed in Saudi Arabia. So for example, if I'm an influencer, and let's say, I am, although I'm not that good looking, but just imagine that I am, and I am a social media influencer, and I charge you I charge you a fixed fee, plus I charge you for every click on your ad. While I am actually, trying to kind of promote your products, everyone who clicks on your products, for example, or there's a link, for example, and who clicks on that, or anyone who avails of, for example, some discount that I am kind of saying that, you can use this. Now, part of my remuneration, and my remuneration is linked to that activity. Then you can also say that, oh, actually, this is an activity in Saudi Arabia, which is necessary for Kashif to earn this income. So therefore, this income is now as if Kashif has performed this in Saudi Arabia. The service has been. So therefore, I think you have to look at the whole arrangement and the precise manner in which the service is being provided. Thank you.
I think probably we can take the last question for the day related to that. From the perspective of timing of issuing VAT invoice for transactions with government, what is the basis of identifying transactions which will fall under the tender and procurement law and which does not fall under such law? And the continuation of this question is, if we cannot issue a VAT invoice for a government transaction which will fall under tender and procurement law until the payment order is issued or payment is received, whichever comes first, how shall the company recognize the revenue upon delivery?
Okay, so I can answer the second question first. The second question is that there's nothing preventing you issuing an invoice. All that the changes to the rules in Article 20 of the implementing regulations do is prevent an invoice creating a tax point. So whereas in other circumstances, when you raise a tax invoice, Zakat can say that VAT you need to pay over in the month that you've raised the invoice. For government transactions, the invoice is disregarded. So you only look at when the purchase order, the payment order, I should say, is issued, or if in the unlikely event that cash is received before then. In terms of the first question, let me just refresh what exactly it's saying. So if we're saying what's the basis of identifying transactions, well, simply looking obviously at the contractual agreement and checking with the entity with which you are contracted is the safest way. It should be obvious in a lot of instances whether the you've been involved with the government procurement database and system and all of the administration around that. We have come across in practice some questions, especially in the transition, as to whether some historic contracts now are automatically governed by the tender law. And the only answer to that, unfortunately, is you need to verify the individual case and check with the counterparty. But for the majority of instances, it should be clear when you're dealing with a government entity, when you need to receive an official procurement order, payment order from them. And so that would be the practical basis of identifying those transactions.
Thank you very much, Peter, for taking that question, and thank you all from all our panelists from Deloitte. I think it's a very useful and timely session, and there's a lot of clarity given during this session, and we hope that we can have you all again with CS Sri Lanka's Western Region chapter very soon to give another update. I would like to thank all of our participants from other professional bodies as well for accepting our invitation and joining with us today. Until we meet you on another session, have a good night. Thank you very much.
And Kashif's Instagram stream is available for subscription.
Yeah, I think we will subscribe and make him a big influencer.
Thank you very much.
All right. So are people still there, or are we still live, or what?
You're still live.
Okay, good. All right. So I just want to thank everyone. So, and feel free